Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 15th, 5:47 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what is important for next week, and review the world famous 21 over 21 leaders list halfway through the month of September. And I would like to say we were all the way through the month of September, as this has been uh, a- lived down to its seasonality. Pretty rough month so far, and the last 2 weeks are actually supposed to be, from a seasonality standpoint, the worst 2 months of September, and stocks might have gotten a jump on that today with really a disappointing action. State of the market: week uptrend, 829 follow through day, barely intact. We tested the lows on the S&P of the follow through day uh, earlier last week. We didn't undercut it today. All in all, if you just look at the numbers, it felt worse than the numbers show when you look at it from a weekly standpoint. And that's typically the case when you close tough on a Friday. But we'll bring up the weekly chart so you can see the returns there. Only 4 of the 21 stocks came off the 21 over 21 list, but the action in leading stocks not good. My message last week was that the indexes were weak, but leaders were fine. Opposite this week, as leaders fared worse than the indexes, except for a couple of standouts. So week up trend. See the trend gauge over here. We downgraded market leaders from bullish to neutral, still sitting on neutral for our short-term 21-day moving average. The Dow, the Nasdaq, and the S&P 500, the three big cap indexes, got back above their 21 and their medium-term 50-day moving average yesterday as part of the post CPI and PPI rally, but failed miserably today. And that's the title of our What Just Happened, and the title of the video: From Failed Moves Come Fast Moves. It's an old Wall Street axiom, and it certainly played out today. So one close back below the 21 and the 50-day moving average for the big cap indexes. Small caps and mid caps continue to languish below their short-term 21-day and medium-term 50-day moving average. Small caps bounced or held right at the 200-day today. Mid caps headed in that direction. So arguably you could get the yellow sub arrow out there also. But remember, the market does not get into serious trouble unless the S&P 500 breaks below the 200-day moving average. So what happened? As I said, from failed moves come fast moves. So yesterday's video was about how we broke out of a triangle, meaning a declining tops trend line and then a rising bottom, rising lows trend line. And pretty optimistic was last night's video. We opened, however, with about a 3% gap down across the board today, and that was basically the high of the day. When the high of the day comes in the first 5 minutes, and there was pretty fierce selling. Today was options expiration. Volumes are typically, actually it was triple witching, which means there were three of the big index products expiring today: options, futures, etc. So volume is typically heavy, and there was no let up in the selling today. When we take a look at the intraday chart, you'll see the two very harsh, very swift down legs today before a little bit of consolidation into the close. But as bad as the indexes were, really, as I mentioned, leaders didn't fare as well as the indexes on a weekly basis when you take a look at the final candles. So here are the numbers. RG8, this is our 8 growth ETF composite, down 1.2%. S&P 500 also down 1.2%. NASDAQ 100 weak all day after the open, down 1.7%. All 7 of the big 7 down today. Dow down 0.8%. Mid caps and small caps down 1.05%. Global Diversified 60/40 stock and bond down 0.57%. Foreign developed nation stocks held up, as well as emerging markets held up better than our domestic indexes today. In-house GROTECTION down 1.47%. The underperformance was primarily because of our index long in the QLD/QQQ. Going into today, we got stopped on that on the break back below the 21 and the 50-day moving average. We'll hit the tail of the tape and the 21 over 21. Let's get right into it. I'm going to take the stochastic off after this first chart so you can see the charts better, but we had a hook down on all 5 of the big cap indexes after a hook up yesterday. And that just is proving it's been going back and forth, whatever sport with a net you want to call it. That's what we've been doing with the 8, the 21, and the 50-day moving average all stacked up there, just providing a net for the ping pong action. Let me take the stochastics off. Let me go to a 5-minute chart here. And you can see the gap down the immediate high and then a really fierce sell-off within the first 90 minutes, feeble bounce over the next hour, another whoosh lower down to 44.47 where we put in the lows for the day that undercut the lows from the prior couple of days. And then a pretty quick uh, move up for 15 minutes, starting at 1:45 into 2 p.m. or 1:30 into 1:45, and then we just chopped slash based for the rest of the rest of the day into the close. Not good action at all. And I want to show the 30-minute range that we've been talking about, along with the breakout that we did yesterday. So Wednesday's video, we drew these triangles and very clear breakout yesterday, very clear failure back into that range today. So arguably now we can draw going forward uh, a, another trading range that we could bounce around in. We'll watch the downtrend line as well as the uptrend lines. Notice we didn't break the lows that were tested on September 6th, September 7th. Here was the follow through day where we touched the lows that day, didn't come there. So as bad as it felt, wasn't as bad from an overall standpoint as where we were on September 7th. So, but failed move. So any optimism that was built up yesterday turns to pessimism on the failure of the move. If your glass is half full, which mine normally is, at least we are still now back to the bottom of the trading range. And if we break below that, that would be much more severe. And as we cut a bunch of exposure today, and we'll be lightening up even more. Let's go to the NASDAQ 100 very clearly and very early. We failed here. Let's go to the 30-minute chart and we'll draw the breakout from the triangle that we saw on Thursday, and again, how quickly that failed back down near the lows that we tested on September 7th, but still not to the lows of the follow through day. So by O'Neill rules, the rally is still alive, certainly on life support. But we are, if you take a step back since October or since August 29th, we're in a trading range and we're at the bottom of the trading range, no different than where we were the middle of last week. Let's take a look very quickly at weekly charts of the NASDAQ 100, and that doesn't look too bad. We're just really still in a bigger, broader range, forming a base after a nice move up. Again, trying to put an optimistic face on it. Down 0.5% for the week. Down 0.5% is, nothing. Basically, here's the S&P 500 down 0.16% for the week. It just felt worse because of the letdown of the failed breakout on Thursday and the big red numbers on Friday. But again, for the week, basically just closing down 0.16%. Let's go to the Dow Jones Industrial Average weekly chart here. Absolutely positive for the week. We'll go to the daily. Still failed the breakout of its triangle and really back into the range. If you look at a 30-minute chart, that's pretty clear. Also, the breakout yesterday and back into the range today, a bit of a wider range. on the Dow, and note the relative strength on the Dow over the last 2 weeks. That's what happens when your market's pulling back. The more defensive index tends to outperform on a relative basis. Let's go to mid caps now. Here's the daily. There wasn't a triangle for it to break out of, but we're back to the lows. So here's the follow through day, the 29th. We've been below the lows of that day for over a week now, and a bigger uh, bottom of the range going back to August 25th is what we're testing. And that's the near now the 200-day moving average, which we really need to hold. Note the relative weakness on mid caps. We've been pointing that out, as well as the relative weakness on small caps. Here's the small cap index. It bounced again at the 200-day moving average. If you go to the S&P small cap 600, this looks even worse. In fact, it's below the IJR, the S&P. These are companies with stronger balance sheets than, because they've got to have profitability requirements to be in the S&P index. But this is more living below the 200-day moving average over the last 3 weeks than the Russell 2000 has been. Not sure what that says, other than what we talked about on the podcast yesterday, that perhaps taking the risk off, because if you look at uh, SLYG. This is the small cap 600 growth, sitting above the 200-day moving average. SLYV, this is the value half of it, well below the 200-day moving average. May just be the case that people feel better collecting their 5% dividend in short-term T-bills than they do taking the risk of stocks in defensive industries, and also in smaller caps, which are inherently riskier than the large caps. So that's our overview on the major indexes. Let's go to the VIX. We were at the low of the range yesterday. We actually undercut the recent low uh, and bounced as the market came off. The VIX bounced. The VIX did not make a higher high relative to the way the index has made a lower low versus Wednesday, and we're still trending below the 21-day moving average. That's kind of a double-edged sword. Does it point to the fact that we would expect a lower volatility with this being below 15? Or is this just waiting for a bigger bounce up and a bigger move down in the markets? We'll have to let the markets tell us that as things unfold next week. Let's go to the dollar. Not good for stocks here. We talked about yesterday how the markets were up yesterday despite higher rates and a stronger dollar. Dollar just barely lower today. Maybe overnight, the market took a look at the stronger dollar and said, hey, hold on here. Why were we up so much yesterday? Maybe it was just a short squeeze. We don't necessarily look to always explain what's going on with the market, because it is inherently unpredictable on a short-term basis, but we can take a step back, look at trends, put some percentages to them, some likelihoods, and that's just what it's all about, is percentages and their likely outcomes based on what we've seen in the past, and inter-asset correlations. With the dollar trading tightly, but being down right from the jump today, gold stocks and gold and silver were strong. Testing the 50-day moving average back above the 21. Pretty decent move up considering what the dollar did, up 0.7 on gold. Gold stocks even stronger, up over 2%, clearing the 21 and the 50-day moving average here. So I would say one conclusion you can draw is that this is looking to be a safer haven based on the relative strength that we've seen over the last week in gold stocks. SLV silver 1.8%. So yesterday looking like a washout, move below this 2052-ish level that we saw back in the beginning of August, undercut and rally. Bitcoin didn't follow the precious metals today, down 1%. Ran into the declining 21-day moving average yesterday, a little bit of a pullback today, but that was a decent move from the close on Monday to the highs on Thursday, kind of a normal pullback there. Let's flip to bonds. Bond prices down today. after running into the declining moving average 21 on Thursday, making lower lows today. Stocks didn't follow suit with what bonds did yesterday, certainly. BND down 0.2%. TLT, this is the long bond, down 0.6%. You're going to see that yield spiked up. TYX clearing this resistance level from the consolidation of a week and a half, with its eyes set now on the highs that were set back to early to mid August. And TNX, that was the talk today. Stocks don't like higher interest rates. Well, they didn't care yesterday, but they certainly cared today. Very near the highs back from early to mid August on the 10-year now at 0.79%. So some delay in the sell-off. Maybe the sell-off was baked in and it just didn't happen yesterday, but the market uh, came to its senses today. I talked about some inter-asset correlation, how it doesn't always uh, go in the general direction, either inversely or in sync. There's different times and different reasons for why it happens, but safe to say that the interest rates up, stock market down, overall trend is intact. So that's the inter-asset correlation. Let's go to the tail of the tape. You can pause this to read the whole thing. I'll hit the highlights. One of the big negative news sentiment that hit tech stocks today was a report that Taiwan Semiconductor told its suppliers to slow down on delivering the equipment to them to make the chips. So that hit the entire semiconductor sector. The SOX down almost 3% on the day, and that certainly took its toll on the NASDAQ 100 also. Back below the 21 and the 50-day moving average, so technically on the bear case, although as you know, we've been playing ping pong, but um, at the lower end of the range. So again, is your glass half full? Is your glass half empty? Well, uh, from an index standpoint, being at the lower end of the range is a lot better than being at the top of the range if the prospects for a breakout don't seem strong, which they don't currently. On the other hand, the action in leading stocks this week leads me to look more toward the glass being half empty, and that's why we downgraded the leading stocks indicator on the trend gauge. So expectations now neutral, with us being both below the 21 and the 50 on the S&P and the NASDAQ 100, again at the bottom of the range. Those two flushes that we had were pretty harsh, and that's why the title of this week's video is From Failed Moves Come Fast Moves. That's absolutely what we saw this morning. Gold, gold and silver stocks, XLP, U, and V showed some relative strength, being down less than the indexes, but those should actually be just on a relative basis, not on a price basis. Uranium continued to be strong, really the only sector outside of the precious metals that was positive on the downside. 11 out of 11 sectors actually down. I always want to note that when it happens for historical purposes. Led to the downside by semiconductor software, home builders with the higher rates, XLK and XLY, the worst of the indexes. In-house portfolio changes. QLD with the failed breakdown, got rid of that in 2 periods of selling in the morning. Celsius. Then we took with that failed breakdown. You have to reassess everything that you're holding when your expectations change, which mine did somewhat today. Celsius, 2 very small losses. We got out of that. CrowdStrike, we just bought it yesterday. Small loss. By small, I mean less than 3-4% on these, and they're 2% position in Celsius, 1% on CrowdStrike. So minor hit to the portfolio. I hate paper cuts, but they're better than something that you would need stitched up. We don't want amputations either, obviously. And we trimmed NVIDIA, the recent buy of NVIDIA, which was down a couple of a percent. That was a 2% buy, as it very clearly broke below the 200-day, or the 50-day moving average, and nobody wanting semiconductors today. Bottom line for today and for the week, S&P and NASDAQ breakout fails, back below the 21 and the 50-day, back to the lower end of the range. We'll now go through the 21 over 21. First of all, we'll highlight the changes that we made to the portfolio. The Qs, obviously, with the failed breakout and the move below the 21 and the 50, had been showing some relative strength by holding up there, but gave that up today. So that we sold QLD. Celsius, I mean, this still looks fine, but it broke below the 80 MA, so minor change in character there. It's subtle. Listen, we can always buy it back. But when the market turns toward the end of the week and it's weak, uh, we- I would just rather take a very small loss and see what next week brings. Same thing with CrowdStrike. Very strange with this. It was down pre-market despite getting a price target raise and an upgrade to 200 bucks a share. Market didn't care. Gap down. This was really the only or one of the few software security stocks that were strong yesterday, but no strength at all today, down 3% on the day, broke the 80 MA, booked a tiny loss on that. And NVIDIA, that 2% buy that we did earlier in the week with the move back above the 50-day moving average and holding, which at the time looked like an undercut and reclaim of the 50-day, but notice it couldn't ever get back above the 21-day. And then the selling today. These red bars have been much higher than the blue bars on 5 of the last 8 sessions that we've been seeing for NVIDIA. So that reduces our exposure to just over 1 at 1.06, and that's with the S&P being equal to a 1 overall. So 4 stocks did get cut from the 21 over 21. Haven't replaced them yet. We'll wait for our sector work that we do over the weekend and make a determination, but we did break. We did cut IBKR. Chart, looks fine, still within the 5% of the flat base breakout, but not really making any progress. And close below the 21. So I keep a separate list, what's between the 21 and the 50 and is healthy. Those would be the first ones that come back on the list if they right themselves in the market, makes it becomes more attractive. Second one that got cut was ANET, just trending lower, bleeding over the last 5 days. Held the 21 yesterday, below the 21 today with waning relative strength. One that didn't drip, but in fact fell hard, fastly after this is what's confounding about the market. It can fool you. 5, 6, and 7 out of 9 up days, including the breakout from this nice ascending base, and continued higher and then just turned on a dime. Selling has been lighter on the way down until today, but we closed below the 21 yesterday when we got stopped out of the last of our position. Continued follow through to the downside, down another 5% on above average volume today. Goes into the above the 50, below the 21 pile, but that's a pretty big disappointment there for Fastly after the way it was acting on its earnings report and then the follow through strength with the ascending base breakout. That was the third one down. The last one down, Axon. Relative weakness this week. I've said that about quite a few of the losers, but a cup and handle showing up, a nice looking cup and handle actually. This hasn't acted badly. It's still above its earnings gap up, but relative weakness this week. Really showing no progress since the close on a relative basis, since its earnings gap up. But again, it'll go into that keep an eye on it pile. So those are the 4 that were cut. Here's the 17 that remain. Granted, they look pretty good, but on a cumulative basis, let me bring up the weekly chart. I always want to do that so that we can see how things did for the week. Keep this in the upper right of the screen, and so you can see that and the daily charts and about the last couple of months of action on the weekly chart. So we'll start off with DraftKings. Weekly forming a cup base, down 2.5% for the week. Tough day today, down 1.4%, but this still looks fine, and has been a relative strength champ on the prior 3 weeks, but just today, but not today or this week. Nutanix, down 1% for the week. Normal pullback, down 2% for the week. That weekly chart just looks more like a short stroke than it does anything that you need to be concerned about. Tesla, good week, great week actually, up 10.4%. Gap up, held the gap, closed near the top of the range for the week. A lot of these you'll all see they're forming bases, and that's what happens. I mean, it may just be a seasonality thing, and we continue sideways to down for 2 weeks, and then use the last quarter for strength. We don't ever try to predict the market. We're aware of all the secondary indicators, and then we watch price and volume, and the overall market and the strength in sectors. CrowdStrike, gap down, sold it, still holding it. Weekly chart looks fine, down 1.5% for the week. Uber, down 1.7% today, positive for the week. Still holding. This is still our leading position with a 5% size. Another cup base that you'll see, relative strength, new highs. Good stuff there. Still, some attractive looking patterns that are forming. Mild pullback for Splunk, down 3% on the week, down 1% today. Volume higher than last week, but just at average and well below the 2 weeks up that it showed. CCJ, uranium has been on fire. We just flat missed this. It happened pretty quick. Went from trending higher to going bonkers higher. Way too extended now, up 8.8% for the week. Not a typical commodity stocks are not your typical growth stocks. Um, that goes without saying. LNW, one that was up for the week, up 2.3%, down slightly today. Good looking, higher highs and higher lows on the weekly pattern. Daily looks good too. Coal accelerated to the upside, hit that 100 level. This is console and reversed, still up 5.3% for the week. Lilly, time for a break, hit the 600 level, pulled back, harshest pullback for the week. Only down 1.8% for the week, and just really a normal pullback in the scheme of how strong it's run on the weekly chart. NVO, same thing, pulling back, but some volume on the pullback this week. 3 days above average volume, down 2.5% on the week. AppLovin, pretty good week here. Tight action, up strong for the week. Held the 21, undercut, reclaimed the 8. Volume today is accentuated because of the triple witching day on expiration. Celsius, ugliest candle for a while, but still only down 2.2% and down 2% on the week. Looks fine on the weekly chart, but again, we cut our losses small. We got into this at 202 and 198, and really a function more of what the market's doing than the stock. NRGU, is it time for a top in oil? Can't always say for sure. This is a volatile one. We've had some nice gains. A break below the 8 and we'll be out, down 3.8%, flat for the week. VRT, you could draw a triangle similar to the triangle that I drew on the indexes, down 2.6% on the week, held the undercut and reclaimed the 21, got an upgrade yesterday, mild pullback today. TBT, higher interest rates is what this represents. You can see a cup and handle forming on higher interest rates, not good for stocks, up 3.1% on the week and up 1% today. And finally, Weatherford, pulled back to the 8. That volume obviously tied to expiration, up 2.6% on the week, and that's what's left. The 17 that are left of the 21 over 21 list. For the most part, leading stocks underperformed the indexes this week. Typical growth stocks, certainly. Some commodity stocks acted well. Some of the true leaders went sideways to mildly positive, but all in all, a very disappointing end to the week for the bulls. Takes us back down to the bottom of the range. If the bottom of the range holds, great. If it doesn't, we will get more defensive. That's the plan going into next week. And with that, I want to remind you it's not how much you make in the market, it's how much of that you can keep. Our flagship portfolio is called GROTECTION. It describes our approach, which is growth in uptrending markets, protection in down markets. When the market goes sideways, that's the toughest of them all. We've been staying within 1% of what the S&P has been doing over the last couple of weeks, buoyed by some good strength in leaders, but lately our small pilot buys into fledgling leaders haven't been doing what they need to do, and that's go higher. And with the negative reversal today, we cut loose a bunch from just holding on to the best of the best. And with that, I'm going to wrap up the Market Insight video big show for the week ending Friday, September 15th. This is Don Vandenbord telling it like it is. Not always telling you what you want to hear, but telling you what you need to hear for what's going on in the overall market. Thanks for listening and have a great weekend.